Hello and welcome to Gould Asset Management's first webinar of 2023. We appreciate you all joining us, and we think you will find our time today to be insightful and informative. Let me quickly introduce myself. My name is Scott Smith. I'm a senior portfolio manager and partner here at Gould Asset Management, and I will be helping facilitate today's talk with Don Gould, our president and chief investment officer. Don is going to be giving us an update on the current state of financial markets, and we'll also be answering questions from you, our viewers. It looks like we have a great turnout today, and I want to thank everyone for taking time out of their busy schedules to join us. We expect today's webinar to last about 45 minutes, with the last 10 minutes being devoted to Q&A. If you'd like to submit a question to Don, you can do so at any time during the webinar. Just enter your question into Zoom's Q&A feature, which you should see at the bottom of your screen. Please post all questions there, as we will not be using the chat functionality to respond to questions. If we don't get to your question live during the webinar, a member of the Gould team will follow up with you directly to make sure we get all your questions answered. Lastly, we are recording today's webinar, and we plan to make the replay available shortly after the completion of today's call. And so without further ado, I'll turn it over to Don. Don, take it away.
Thanks very much, Scott. And good afternoon to all of you, wherever you may be. For all of our friends and clients in California, I hope that you're surviving these rains, which seem to be never ending, but at least we need the water, right? Well, let's get right into it. I'm going to start by just saying it's all about the pandemic. And you might think, I thought that was mostly behind us. But as far as what we're seeing today in financial markets and what we've seen over the last 3 years, it's still all about the pandemic or the after effects of it. So what's all about the pandemic? The crazy volatility that we saw in 2020, of course, the unbelievable nearly 2-year bull market that followed the initial volatility, which lasted until the end of 2021, the really very difficult stock and bond markets of 2022, last year, the turbulence that we've already seen this year in 2023, which is not even 3 months old, the banking turmoil that began about 2 weeks ago, and even the looming debt ceiling showdown. All of them, to greater or lesser degrees, are after effects of the pandemic. So why is it all about the pandemic? In February and March of 2020, which is 3 years ago now, hard to believe, we saw the most sudden economic downturn ever. Large parts of the economy shuttered overnight. To prevent an economic depression, the US government carried out massive fiscal stimulus, that is government spending, and also supported that with massive money printing by the Federal Reserve. We're talking about perhaps as much as $5 trillion in stimulus, about 1/4 of our annual GDP. Now, the initial effect of injecting so much money into the economy was what I might call an asset inflation. In other words, the price of assets went up sharply. And so let me just start with our first chart here. Scott, you're going to need to enable that. Give us 1 second here. Okay. So this chart is simply the S&P 500 from the beginning of 2020 until the end of 2022, so a 3-year period. And you can see after the initial sharp drop at the beginning of the pandemic, amazing bull market ensued with a rise of more than 100% in 21 months. That's the equivalent of about 8 years of average stock market gains compressed into less than 2 years. But stocks weren't the only thing that went up in price. Home prices skyrocketed, and pretty much every other asset rose in price, whether it was newer assets like cryptocurrencies or old assets like fine art. Now, as the economy returned to normal, The next effect of all that money printing was inflation, but inflation as we most commonly use the word. And that means higher prices on all variety of goods. You know, everything from groceries to plane tickets to you name it. We've all seen it. There's been quite a dramatic rise in prices. So let's look at another chart. So here you can see the US Consumer Price Index going back to 1973, in other words, 50 years. And you can see the 70s, you may recall, was a period of very high inflation. Inflation finally was brought under control around 1980 and basically stayed pretty quiet, roughly around sort of the 2.5% level, you know, with some up years, some years below it, until we get to 2022. And then you see this very sharp spike in inflation, taking it up to levels that we haven't seen in about 40 years anyway. So if you think about it, in 2020 and 2021, the Federal Reserve, driving the car, so to speak, puts the pedal to the floor, printing as much money as it possibly can put into the system. And then in 2022, after sort of the worst fears about economic downturn were behind us, then we see the consumer price index jump way up, and the Fed then has to slam on the brakes and do so in the only way that it really can, which is to raise interest rates. So let's look at another chart, see how that looked in the last year or so. So you can see here, 2021, short-term interest rates are basically bumping along right around zero. The 10-year Treasury interest rate is moving between 1 and 1.5 and kind of settling out at 1.5. And then the Fed here in late 2021 starts raising short-term interest rates. They also did other things that would raise interest rates on longer maturity securities, such as selling off parts of the huge balance sheet of accumulated fixed income securities that they built up during the pandemic. So you can see that both short-term interest rates in the orange and longer-term interest rates in the blue went up dramatically. And this is one of the largest one-year increases in interest rates that we've ever seen. So it's quite a shock to a system that had become used to pretty low interest rates dating back all the way pretty much to the 2008, 2009 great financial crisis. So that brings us to 2022. And in 2022, the market had to deal with higher interest rates. And higher interest rates, as we discussed over and over, are bad news for bonds. A lot of people find that unintuitive. Don't I want a higher interest rate on my bond? Yes, higher interest rate is good if you haven't already bought the bond. So it's good for people who are buying new bonds. But if you have a 2% interest rate bond for, say, 10 years, let's just say you have $100,000 in that bond, that's going to pay you $2,000 per year interest for the next 10 years. If for whatever reason, tomorrow, new bonds are being issued with a 3% interest rate, meaning $3,000 per year, well, your bond that only pays the $2,000 per year is now inferior. And compared to the new bond, it's got to be worth less in price. And so what happens is that the price of existing bonds goes down when the interest rate on newly issued bonds goes up. Now let's take a look at yet another chart. Here we go. Okay, so this is a good case in point. You can see what happened in 2022. So as we pointed out a minute ago, the 10-year US Treasury note started the year with a yield of 1.5%, pretty low yield by historical standards. And then we saw in the earlier chart how the interest rate on new 10-year Treasury bonds rose to about 4% by the end of 2022. So consequently, the price of the 10-year bond that was issued at the beginning of 2022 was going to fall in price in order to keep its effective yield competitive with the yield on newer bonds. And that price decline was 18%, which is a huge drop for a bond, certainly in a one-year period. Now, the total return on the bond is the sum of its yield, the interest, and its price change. So the total return wasn't quite as bad as the price change, but it was still pretty bad, down 16.5%. One thing to note, and I'll come back to, is that obviously this 1.5% being a historically low yield gave very little cushion to the price decline, and consequently the total return wasn't much better than the price decline. If we look at another chart here, this shows you here on the left, here on the right shows you what actually happened last year. So in addition to bonds being down, and this is the bond market index as a whole, which is not quite as interest rate sensitive as the 10-year Treasury, so it was down only 13%. The stock market was down about 18%. So we had quite a bear market in stocks as well. That gave back about 1/3 of the previous bull market's total gains. But the real problem with 2022 wasn't that stocks went down or that bonds went down. The problem was that they both went down, and significantly, and in the same year. So you can see in the orange here that a balanced portfolio of say 60% in the stocks and 40% in the bonds was down about 16%. Now, if you look here on the left, this shows you what's more normal in the case of a stock bear market. So we take the same 18% loss of last year, and then we look at what have bonds typically done over the last 25 years. They've done about 4% per year. So if bonds had done 4% positive last year, and you had a 60-40 portfolio, instead of being down 16%, you'd be down a much more manageable 9%. And the reason for the difference here is the type of stock bear market we were dealing with. So we call this a normal bear market, and it's normal in the sense that stocks and bonds are inversely correlated. And usually they are, because usually stocks go down because the economy is slowing. Corporate earnings, therefore, are not growing as fast, or maybe are even shrinking. And when that happens, the demand for money also tends to go down, which tends to push interest rates down and pushes bond prices up. So this is kind of your typical bear market where the bonds cushion the decline of the stocks. But 2022 was different, and it was something we haven't seen in a long time. It was a bear market that was really really driven more from the inflation. The high inflation forced the Federal Reserve to raise interest rates. And so rapidly rising interest rates were the cause of the stock bear market last year, rather than simply a reflection of a strong economy. So inflationary bear markets, you will tend to see this positive correlation between stocks and bonds, which makes the balanced portfolio less able to cushion the blow. So the bottom line is there was almost nowhere to hide last year. And the moral of the story, at least one moral of the story that I take away, is that there really is no free lunch when you print money. Printing money cannot change the productive capacity of the economy. That's not to say that the money printing was ill-advised, but simply that you can't expect it to, over the cycle, actually increase aggregate wealth. In 2020 and 2021, it may have helped the economy avoid a more severe slowdown and therefore run closer to its full capacity. And that's what we hope that government intervention does. But in 2022 and 2023, the money printing ultimately caused the economy to run hotter than its capacity could support. And the result was inflation in goods and services, which made 2022 the tough year that we've discussed for stocks and bonds. So just to kind of see how it all ultimately comes out in the wash, I have a couple charts that I think are instructive. This is the chart that we saw earlier, which shows the S&P 500's price from the beginning of 2020, and then the sharp decline at the beginning of the pandemic, then the big bull market we discussed, and then the bear market of 2022. And so if you kind of try to look beyond the noise and the volatility and just look at where we started and where we ended, the annualized return on the stock market over that 3-year period was about 8% per year, which is only a little bit below the stock market's long-term average annual return. So despite all the money printing and all the craziness and all the volatility and all the things we saw in the markets over the last 3 years, ultimately what came out in the wash is sort of what you expect. This next chart shows this concept in a different way. This is real GDP. So this is the economy itself, the size of the economy, gross domestic product. You can see going all the way back to 2001 that the economy has basically grown at about a 2% per year rate. That's net of inflation. So a real growth rate of about 2% per year. The circled area here shows the pandemic. So you see how the economy fell off a cliff in 2020. But look at what happened. As the economy recovered and as we came out of the pandemic, GDP went right back to its long-term growth line. It's off it a little bit lately, but you get the idea that ultimately these things are self-correcting. The money printing did not create wealth, but it might have helped us avoid a severe downturn that would have caused a unrecoverable loss of output. All right, so let's move to 2023. And where are we? Well, I think the main issues for 2023, and number one, is inflation. Will it persist or will it finally subside? We have seen inflation come off the peak numbers of late last year. But so far, it's not coming down probably as fast as anyone would like, including the Federal Reserve. So you might say it's been a little stubborn. So a big question for 2023 is inflation, finally going to calm down? A lot of that depends on the strength of the economy. Now, there are 100 ways to measure the strength of the economy, but here's one. This is just simply the unemployment rate over the last 15 years. So you can see here the great financial crisis and the recession, and then a steady decline in the unemployment rate down to pretty much the lowest levels we've seen in many decades, in the sort of 3.5% range. And then the pandemic comes, and overnight, unemployment rate almost quadruples. And then as we come out of the pandemic, we've come all the way back down to here. Now, this number hides a number of other things, like the fact that labor force participation rates are down, but it's still a very useful number in understanding how hot the economy is running. I mean, right now, in general, it is difficult to hire workers. We've seen lately a lot of layoffs in the tech area, but that hasn't really spread to the economy as a whole. So the Federal Reserve is looking at economic statistics like this one very closely to try to gauge whether they need to administer more of the high interest rate medicine to try to slow this economy down. Okay, what are the other issues we've got to deal with this year? Well, one is, are we going to have a soft landing or a hard landing? I'm going to talk about what those terms mean in a minute, but you hear them a lot. the opinions on all of these things, inflation, the strength of the economy, is it going to be a soft or a hard landing when the economy finally does slow down? All of these market opinions have fluctuated from month to month, day to day, and even today from hour to hour. So I'm going to show you another chart that I think speaks to this point. This is 2023, so just a little under 3-month period. And the green line is the stock market, and the brown line is the bond market. And you can see in January that both of them were trending upward. Basically, as I think, the market had the attitude that the Fed was getting the upper hand on inflation, and that things would be better. But then in February, there were some employment numbers that were stronger than expected. And so the sense was maybe they don't have the upper hand. And so you see bond prices going down as interest rates went back up. You see stock market going down with it. At the end here, you see a reversal in the relationship. And this is reflective of the banking turmoil that we've had over the past few weeks. And so, the reasoning here, the idea here is that in a banking crisis, people are going to tend to run for government securities, what they would call a flight to safety. And that pushes their yields down and pushes their prices up. At the same time, stocks are always going to suffer whenever there's significant uncertainty injected into the financial system. But more recently, you can see they've reversed course, stocks moving back up, bonds moving back down, perhaps as the fears over this banking turmoil have subsided a bit. All right, so let's talk about, let's talk about 2023, and specifically the markets. So, interest rates have gyrated, but at the moment, interest rates are actually down meaningfully for the year. They started the year close to 4% on the 10-year Treasury yield and closed today at about 3.4%. So consequently, as we discussed, bond prices and interest rates move in inverse directions. So bond prices are up so far this year. Stock prices, as we just saw in the chart a minute ago, have generally tracked bond prices. And so they're also up for the year. And so despite all of the volatility that we've already experienced in 2023, it's been a good first quarter for stocks and bonds. And both are up a little bit over 3% year to date. Our outlook for the rest of the year, as always, we say the crystal ball is hazy because nobody really got a crystal ball. But there are a few things I think we can say with some confidence. First would be that bonds will likely do much better this year than last year, and for at least two reasons. First is that you start the year with a 4% yield on the 10-year Treasury bond. So unlike last year when you started at a 1.5% yield, you now know you're going to get interest income equivalent to about 4% on your bonds this year. And so that's a much bigger cushion. So even in the event that bond prices go down this year, you've got a 4% head start. So that's the first thing that should help bonds this year. But second, even if interest rates do continue higher, we believe they're unlikely to rise nearly as much as they did last year. And we're actually now at the point where a lot of the time when the Federal Reserve raises short-term interest rates, long-term interest rates go down. So even if the Fed does have to raise short-term interest rates more this year in order to combat inflation, the effect of those higher interest rates are sufficiently depressing on the economy that the yield on longer-term bonds will go down in response. Well, where does the economy and inflation go from here? The honest answer is we don't know. But let's talk about soft landings and hard landings. A soft landing could be described as one in which inflation moderates. The Fed, therefore, is able to stop raising interest rates relatively soon. And if there's a recession, it's a mild one, or we avoid recession altogether. That kind of environment would be a good environment for both stocks and bonds. In contrast, a hard landing is where inflation remains stubbornly high. The Fed has to continue to raise short-term interest rates aggressively. We get a recession, and the recession is more severe. And in that case, you would expect corporate earnings to be hit significantly, which would be bad news for stocks, but it would certainly be good news for high-quality bonds. Not so good for so-called junk bonds, those that have lower credit quality, because they are more highly correlated with stocks in that kind of environment. Fed Chair Jerome Powell spoke yesterday, and he was consistent. He said the Fed will maintain higher rates until inflation subsides, and they'll raise rates further as needed. He said specifically to expect at least 2 more rate increases this year on the short end of the curve. Yesterday, when that news came out, long bond yields dropped sharply, pushing bond prices up, while stocks fell sharply. Today, at the opening, just the opposite happened. And then toward the close today, there was kind of a backpedaling. So in less than 24 hours, it seems like market consensus swung from a hard landing to a soft landing and then halfway back. And I think this shows just how the outlook for the rest of 2023 remains really difficult to forecast. The banking turmoil, which I'm going to discuss in a minute, is a new variable in this whole equation, because the banking turmoil certainly will have the effect of making borrowing costs higher. And so in a sense, it functions much like a Federal Reserve interest rate increase functions, which is that at the margin, it slows the economy a bit. It hurts consumer confidence. It might enable the Fed to be less aggressive in its rate hikes for the rest of the year. We looked at the chart earlier that showed how in a normal market, stocks and bonds tend to have a bit of a negative correlation, whereas last year they had a positive correlation. I think it's reasonable to expect this year that the correlation between the two will be either low or negative. And either one of those would be good news for a balanced portfolio. We think that in either scenario, a hard or a soft landing, balanced portfolios probably have a significantly better year this year than in 2022. Okay, let's turn our attention to the recent headlines. The phrase that the Wall Street Journal uses is banking turmoil. They generally avoided the word crisis. I think it's just interesting to see how the media treats things, but I think that turmoil is less alarming than crisis, but choose your word. The banking turmoil that we're seeing now, I would argue, probably began with the collapse of the crypto exchange FTX a couple months ago. That caused ripple effects throughout the crypto industry. A relatively unknown bank to most people, Silvergate Bank of La Jolla, California, was a large, had a large book of business with the crypto industry. They essentially functioned as a entry point into the dollar-based banking system for a lot of crypto companies. So when somebody wanted to convert their cryptocurrency into US dollars, often it flowed through Silvergate. And so with the collapse of FTX and then the domino effects with other crypto firms, Silvergate suffered a tremendous loss of deposits and ultimately had to close itself down. And then just a couple days later came the really stunning collapse of Silicon Valley Bank. And I want to, again, tie this back to the pandemic. So let's look at another chart here. This is from 1975, so going back, again, almost 50 years to the present. What we're looking at here is the total dollar value of deposits in U.S. commercial banks. And you can see sort of a steady climb over time. You know, this probably translates into a fairly steady percentage rate of growth. And then you see the pandemic and that $5 trillion that I keep talking about. And you see this massive, almost vertical jump in deposits, followed by not quite vertical, but a much steeper rise in deposits than we've seen in any of the prior, 40 plus years. So, we're looking here at going from about 13 trillion in deposits to about 18 trillion. Well, what do you know? $5 trillion. Now, how does this relate to Silicon Valley Bank? Well, Silicon Valley Bank is a bank that catered to young companies that had been funded by venture capital. And $5 trillion that was pushed into the system had the effect of pushing money into all kinds of assets, including venture capital. And so Silicon Valley Bank's deposit base over the last 2 to 3 years more than tripled. It went from something like $60 billion for a bank that had been around for, I think, 30 or 40 years to about $200 billion at the time that it collapsed. When a bank gets that much money that quickly, you have a problem. And particularly when it gets that much money in a very low interest rate environment. I mean, normally banks take money in gradually and they generate loans. So they loan out the money, but loans take time and effort and transaction costs to generate. When you suddenly get, say $140 billion of new deposits that quickly, you can't generate loans that quickly. So you're trying to earn a positive spread between the cost of your deposits, which was roughly zero when they were taking this money in, and what you can earn on your assets. But since you can't generate loans, you're going to go out and you're going to buy securities, essentially different kinds of bonds. But they were buying bonds at very low interest rates. And as we talked about many times in this call, when interest rates go up, the market price of those bonds goes down. So they had a mismatch in their assets and liabilities that left them very vulnerable to a rise in interest rates. But the second problem they had was they had this concentration of client base, a relatively small number of venture capital funded firms who are all talking to each other and who have large deposits. And because they're large deposits, as in anywhere from 5 million to many tens or even hundreds of millions of dollars, these deposits were not insured by the FDIC. So when the Silvergate Capital collapse happened and people started thinking, well, who else is vulnerable to this kind of run? It didn't take long for people to think, Silicon Valley Bank, they could be vulnerable. And so you had massive deposit withdrawals, and the bank could not sell its assets fast enough to meet those withdrawals. And to the extent they could sell assets, they were selling them at a loss. So their net worth was disappearing. And so they went from a going concern to a company in liquidation. 1 second. That brings me to another chart. So this chart shows you the percentage of deposits for several different banks, the percentage of their total deposits that are under 250,000, meaning insured by the FDIC. And you can see Wells Fargo, US Bank Corp, JP Morgan Chase, Bank of America, much higher percentage of insured deposits than Silicon Valley Bank, which was only 2.7%. Citigroup too. But what this chart doesn't show you is that the government has already told us that in effect, these very large banks, 100% of their deposits are insured. Even if you have $10 million sitting at JP Morgan, it is in effect insured because they've been designated as a systemically important bank. And these banks are considered, quote, too big to fail. And this too big to fail has had the ironic effect of making banks that aren't too big to fail more likely to fail. And we've seen this problem recently with First Republic Bank, which has suffered a major outflow of depositors. I think that this banking crisis, unfortunately, has not been a shining day for our bank regulators, both before and during the crisis. The regulators should have seen how rapidly Silicon Valley Bank's deposit base was growing. They should have seen how concentrated their depositor base was and that it could flee all at once. And they should have seen the extreme mismatch between the bank's assets and liabilities. And then when the crisis hit, I don't think they handled it very well. On the Friday when the FDIC closed the bank, they announced that on Monday, insured depositors would get their money, but uninsured depositors would get an IOU from the FDIC, which wouldn't probably enable them to recover all of the remainder of their deposit. Well, that essentially caused customers of other small and medium-sized banks, those not considered too big to fail, to rightly worry about the safety of any uninsured deposits that they might have, i.e. any deposits over $250,000. And that, of course, can lead to more bank runs, and that's exactly what the regulators don't want. And they're still waffling about how they're going to deal with this, which I think is one of the reasons that the turmoil persists. The final item I want to touch on before we go to Q&A is the debt ceiling, which was in the headlines until the bank turmoil bumped it out of the headlines. So what you see here is our federal deficit over the last 10 years. We have a deficit for a simple reason. The government each year spends more money than it collects in taxes. And you can see that the deficit was bumping along at roughly $500 billion per year, grew up to a trillion in 2019, and then just skyrocketed in the first two pandemic years, and then has come down dramatically since then. Now, the accumulation of the deficits is what leads to the national debt. So each year you run a deficit, you add to the outstanding national debt. And so you can see over the same 10-year period, the national debt has almost doubled from about maybe 17 trillion to about 31.4 trillion, which is the legal ceiling under existing legislation. In order for the government to net borrow more money, Congress will have to pass legislation that the president would sign that would raise this ceiling to a higher number. There's a lot of politics involved here. If you think back to the 15 votes that it took to confirm Kevin McCarthy as the Speaker of the House of Representatives, what that tells you is that there are many relatively small factions, whether it's those few Republicans who would not initially vote for McCarthy, whether it's President Biden, whether it's a couple senators in the Senate. Any number of small factions can basically block the passage of a bill to raise the debt ceiling. And consequently, any small faction can try to demand concessions in order to get their votes. And so we have this kind of game of political chicken going on, where, you know, if the ceiling isn't raised, ultimately sometime this summer, the Treasury will not be able to pay all of the government's bills. And then it becomes a question of, well, whose bills doesn't it pay? My guess is it would continue to pay Social Security, Medicare, and probably principal and interest on Treasury securities, but it would still be a train wreck. In 2011, we got close to a train wreck, and the U.S. Treasury securities are actually downgraded from AAA to AA, where they remain today. I would say that the political system is more polarized today than it was then. So it's entirely possible that we'll go beyond the 11th hour this time. And if we do, it's going to, I think, probably stir some panic. Our advice is stay calm, because ultimately that panic will be self-correcting. The political pressure on Washington to ultimately raise the debt ceiling will be irresistible, and it will get raised, but perhaps not before there's some significant reputational damage as well as frayed nerves. Okay, so Scott, let's move over to Q&A.
Great. Well, thank you so much, Don. Fantastic overview. How we got to where we are today and what to look forward to as we move ahead. Let's jump into Q&A since we don't have a ton of time left. First question, Don, has to do with sort of the banking crisis and how to think about our custodians. The question is, in light of recent volatility in the banking sector, how should we think about the safety of our assets at our custodians, such as Fidelity, Schwab, TD Ameritrade?
Sure. Well, the first thing I'd say is there's a big difference between a bank deposit and a custodial account. A bank deposit is a loan to the bank. You may not think of it that way, but that's what you're doing when you put money in a bank. You're lending it to the bank. And your ability to write a check or to withdraw that deposit depends on the bank's ability to pay back your loan when you demand it. Now, it's hard for the average customer to evaluate a bank's ability to pay back a loan. So the FDIC was put in place to ensure the first $250,000 of each deposit. So you can keep amounts up to $250,000 in a single bank and not have to worry about its ability to pay you back. If the bank can't pay you back, the government will. Now, in contrast, an account at Fidelity or Schwab simply means that they have custody of your assets. There's no IOU involved. Now, many decades ago, instead of having an account at Fidelity, say, you might have held all your stocks and bonds in the form of physical certificates that you kept in a safe deposit box. So today you can think of your custodial account as sort of an electronic safe deposit box that holds your investments. The assets are segregated in your name on the books of the custodian. And so I would say, for amounts in excess of the FDIC limits, the custodial account is arguably a much more secure arrangement because it's never an IOU between the custodian and you. So that's the difference.
Great. Next question has to do with CDs. Clients asking, are CDs attractive right now?
Okay. Well, CD rates are certainly much higher than they were a year ago. So in a relative sense, they're a lot more attractive than they were a year ago. But we think that Treasury bills and Treasury money market funds are still the much better deal for a number of reasons. First is that actually their yields are higher than CDs. The second is they have no early withdrawal penalties. Most CDs do. Third, they effectively have unlimited full faith and credit guarantee of the US government. Whereas, again, as we talked about, the FDIC only goes up to $250, and whether any amount above that is covered kind of depends on what the Treasury Secretary says from one day to the next. And finally, if you live in California or New York or, a state with a significant personal income tax rate, Treasury securities are exempt from state tax. And that can mean as much as an extra 0.5 percentage point in your after-tax yield, whereas the interest on CDs is subject to California, New York, and other states' income taxes.
Great. Next question has to do with ESG or responsible investing. ESG has been in the news a lot lately. What are your thoughts?
Yes, it has. In fact, President Biden's first veto of his term as president occurred earlier this week. ESG stands for environmental, social, and governance. And the idea behind ESG is that you might, if you chose to, you could factor environmental, social, and governance into your security selection process, presumably favoring companies that you feel are doing a better job in those three areas. There are a variety of ESG rating services out there that look at the entire universe of publicly traded stocks and assign a numerical rating to each stock with respect to E and S and G, and then an overall rating. Now, like just about everything else these days, this issue has become pretty highly partisan. Because obviously in this country, people's values can differ quite sharply. Our view on this is that investors should be able to decide if they want to apply their personal values in their investment decision-making, and if so, which values. But at the same time, we also think that no investor should ever be forced to apply someone else's values to their portfolio construction. We have some clients who very much want ESG and others who very much don't. And, you know, even those who do want ESG, there's not uniformity in their values or in their priorities. So our job, as we see it, is just to help the client navigate the decision. So, for example, if a client doesn't want to own certain industries or certain companies because they view those investments as contrary to their own personal values, we will advise them on what avenues are available to accomplish that. And we'll also advise them on what the trade-offs are, because again, it's not a free lunch. You have pros and cons to any decision to alter the portfolio from something that wouldn't factor in ESG. But the main idea is that if a client wants to pursue this, we want to be sure that they're making an informed decision.
All right, I think we got time for maybe one last question. We have an attendee who's wondering if you think the Fed can effectively fight inflation while also stabilizing the banks at the same time.
Well, yes, this is the tightrope that that the Fed has been walking over the last few days. Yesterday, they clearly said, you know, that they felt the banking system was sufficiently stable that they could make inflation fighting, or they could continue to have inflation fighting be their top priority. And so they raised interest rates, you know, another 0.25%. You know, I mean, the question, of course, again, requires a bit of a crystal ball as to whether this banking turmoil is going to accelerate or whether it's going to calm down. My own view is that I think on balance, I think it is tending toward calming down. And that being the case, I think that we can expect the Fed will continue to have its, you know, its top priority on inflation. But it's also worth noting that, you know, these things are subject to change literally in hours. We saw, you know, one of the biggest banks in the world, Credit Suisse, be forced into a fire sale merger with UBS over the weekend, Union Bank of Switzerland. So it's a fluid situation, as they say, and we'll just keep an eye on it.
Have to watch and see. All right. Well, thank you so much, Don. And thank you to everybody who was in attendance today. We'll continue to have these webinars periodically. If you have ideas for topics you'd like us to cover, please don't hesitate to reach out to your portfolio manager and let us know what you're interested in getting our thoughts on. So with that, we'll say goodbye. Thanks, everybody.